the Indian economy has naturally been impacted by the global economic situation. We have been grappling with the problem of high inflation. Financial markets have remained uneasy despite intermittent corrections. We have witnessed large portfolio outflows to the tune of US dollar 13.3 billion. I repeat, 13.3 billion during the current financial year so far, that is till 3rd of August, that is till 2 days ago. Nevertheless, with strong and resilient fundamentals, India is expected to be amongst the fastest growing economies during the financial year 22-23, according to the projections of the IMF. Let me now dwell briefly on the MPC's rationale for its decision on the policy rate and the stance. Against the prevailing adverse global environment, the MPC noted that domestic economic activity is resilient and progressing broadly along the lines of the June resolution of the MPC. Consumer price inflation has eased from its surge in April, but remains uncomfortably high and above the upper threshold of the target, that is 6%. Inflationary pressures are broad-based and core inflation remains at elevated levels. The volatility in global financial markets is impinging upon domestic financial markets, including the currency market, thereby leading to imported inflation. While inflation, or rather let me put it this way, with inflation expected to remain above the upper tolerance threshold in Q2 and Q3 of the current financial year, the MPC stressed that sustained high inflation could destabilize inflation expectations and harm growth in the medium term. The MPC therefore judged that further calibrated withdrawal of monetary policy accommodation is warranted to keep inflation expectations anchored and contain the second round effects. Accordingly, the MPC decided to increase the policy repo rate by 50 basis points to 5.4%. The MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. At the same time, the domestic economy faces headwinds from global forces, namely protracted geopolitical tensions, rising global financial market volatility, tightening of global financial conditions, and global recession risks. Taking all these factors into consideration, the real GDP growth projection for 2022-23 is retained at 7.2%, with Q1 at 16.2%, Q2 at 6.2%, Q3 at 4.1%, and Q4 at 4%, with risks broadly balanced. Real GDP growth for Q1 23-24 is projected at 6.7%. Now, there may be a question, which of course will come in the subsequent press conference, but I think to remove any ambiguity even at this point of time, let me say that somebody might as well ask that in the Q3 and Q4 of the current year, the growth goes down to 4.1% and 4% in Q4, then suddenly it goes up to 6.7% next year. What is happening is that the base effect is at play, and the 4.1% and the 4% in Q3 and Q4 of this year are primarily due to base effects. We can explain in more detail during the press conference, which will come up at 12 p.m. Inflation. Now let me focus on inflation. June 2022 was the 6th consecutive month when headline CPI inflation remained at or above the upper tolerance level of 6%. Looking ahead, the inflation trajectory continues to be heavily contingent upon the evolving geopolitical developments, international commodity market dynamics, global financial market developments, and the spatial and temporal distribution of the southwest monsoon. Since the last MPC meeting, however, there has been some let-up in global commodity prices, particularly in the prices of industrial metals, and also some softening in global food prices. Domestic edible oil prices are expected to soften further on the back of improving supplies from key producing countries and government's supply side measures. The resumption of wheat supply from the Black Sea region, which happened a couple of days ago, if it sustains, could help to temper international prices of wheat. Supply chain pressures, though elevated, are on an easing trajectory. Further, the advance of the southwest monsoon is by and large on track, and Kharif sowing has picked up in recent weeks. The shortfall in Kharif sowing of paddy, however, needs to be watched closely, although the huge buffer stocks that are available are, will provide some kind of moderating impact on possible inflation. Household inflation expectations have eased, but they still remain elevated. Incidents of unseasonal and excessive rainfall, if any, can impact food prices, especially the prices of vegetables. Greater transmission of input cost pressures to selling prices across manufacturing and services sectors may also create fresh price pressures. Moreover, persistently elevated cost of living conditions could translate to higher wages and further price increases, especially if pricing power of firms strengthen. Taking into account these factors and on the assumption of a normal monsoon in 2022 and average crude oil price, that is Indian basket of $105 per barrel, inflation is projected at 6.7% in 2022-23, that is the current year, with Q2 at 7.1%, Q3 at 6.4%, and Q4 at 5.8%, with risks evenly balanced. CPI inflation for the first quarter of next financial year 2023-24 is projected at 5%. The inflation trajectory is now poised at a decisive point. While there are incipient signs of a confluence of factors that could lead to further softening of domestic inflationary pressures, there remain significant uncertainties. In such a milieu, with growth momentum expected to be resilient despite headwinds from the external sector, monetary policy should persevere further in its stance of withdrawal of accommodation to ensure that inflation moves close to the target of 4% over the medium term, while, of course, supporting growth. A calibrated approach would provide sufficient flexibility to monetary policy in the current uncertain environment. During the current financial year, that is till yesterday, August 4th, the US dollar, that is the index, that is the DXY, has appreciated 8% against a basket of major currencies. And I'm now talking about our financial year, that is from 1st April this year. So DXY has appreciated by 8% against a basket of major currencies. In this milieu, the Indian rupee has moved in a relatively orderly fashion, depreciating 4.7% against the US dollar during the same period, that is till yesterday. So the rupee depreciation has happened in an orderly fashion thanks to the stated policy of RBI and thanks to our steady improvement in the market to prevent volatility. So rupee depreciation has happened in an orderly fashion, and rupee has depreciated by 4.7% against US dollar till yesterday, and it has fared much better than several reserve currencies as well as many emerging market currencies as well as many of our Asian peers. And as I started reading this statement, the rupee since this morning has appreciated, and I think the depreciation, instead of being 4.7%, would be a little lower, but we have to, of course, wait till the end of the day, and it is a continuing process that goes on.
It's great to see you here. Thank you for watching our work. If you haven't subscribed yet, don't forget to click the bell icon and subscribe to Mojo Story and support independent, robust journalism.